in this FB Live, what I'm going to talk to you about is option selling. And option selling is quite popular, and a lot of people will tell you because option selling is, options are decaying asset, so you can sell and just collect the free income. So is it really free? Is it risky? Is it not risky? That's what I'm going to talk about today. And if you sell option, I would like to see if you have been selling option. So make that comment, and when I go through it, I will be able to see your comments and come back to you and say whether or not option selling, how many of you are selling options. So let's get started. Let me first share with you what is option selling. Okay, so let's look at in more details, and let's say I'm using this x-axis represents the stock price. This represents stock price, and on the y-axis it represents P for profit and L for loss. This is in dollars and dollars. And this is stock price is going from low to high. Low to high. So let's take an example of a company called Tesla. Now, I know many of you love Tesla. Many of you were in the coaching calls yesterday where we built a very low risk, high reward Tesla bullish trade. And Tesla ended up pretty nicely up last night. So we'll see where it goes today, but our trade is already profitable. So if you are one of those who took the Tesla trade, can you mention in the FB Live? Can you mention in the comments that I took that trade? I took Tesla trade. I took Tesla trade. So let's go ahead. Let's say Tesla is at $500 and it goes to 550, goes to 600 and 650. This is what I meant when I say stock price going from low to high. Now, as you buy a stock, let's say you purchase the stock at 550. This was your purchase price, 550. Now, if the stock goes up, you are making dollars. If the stock goes down, you are losing dollars. It's as simple as that. It follows this trajectory or this diagonal line. If the stock is going up, you are accumulating profit. If the stock is going down, then of course your stock is losing value. So there are two types of positions that you can take when you have a stock. You can buy the stock, buy to open. When we say buy to open, meaning this is your first position. And there is another type which maybe let's call it sell to open. So when you choose sell to open, this means that you do not have that shares and you are shorting. So some people also call it shorting the stock. Some people call it naked selling. Some people call it, just selling to open. But the concept is same. You do not have the stocks. You're actually borrowing it and you short sell. So how do you make money when you are trading the stocks? And then we will relate that to option selling. So let me just share this with you. When we look at those two transactions, how are we making money? By the way, any one of you have shorted shares? Anyone traded naked shares before? Like you don't own the shares and you shorted the shares? So let's talk about two scenarios. Scenario 1 and scenario 2. In scenario 1, you are long stock. And scenario 2, you are short stock. So when you are long stock, this simply means that you are buying. So long is like buying to open. We all know about Warren Buffett. We know about other value investors. You're buying low so that you can sell it high. You're buying and holding and etc. This is also called long because you're holding it for long run. This is also called long. And then short simply means that you sell to open as first transaction. Now there are 2 or 3 things that can happen. Let's look at the first scenario, and that scenario being that the stock actually goes up. Now if the stock goes up and you purchase shares, you make profits. But if you shorted the shares to begin with, then it is going against your position, and you will be losing share, you will be losing the dollars here. But what if the stock actually goes down? So if the stock goes down, then your long share will be losing the dollars and your short share will be gaining. Now, why is that the case? Because you bought it at the low price and you can sell it at a higher price. This is why you make money in this scenario. You buy it lower and it actually goes lower. This is the case. In this scenario, that's why you lose value. Similarly, in the share, in case of the stocks, when you shorted, if you bought low, actually, or whatever high price and it goes higher, you lose money in this scenario. But similarly, if the stock actually you bought, let's call it lower price, and it actually goes even lower further, it ends up in the price. So you can see that when you are shorting the share, price decline is in your favor and price rise is against you. So we are not going to focus on this long portion. We are going to focus on short portion. This is the area that I'm going to focus upon now, and we go into more details about this area. So let's say we are looking at option selling. There are two types of option. One is call option and second is the put option. And usually, or generally speaking, call option makes money if the stock goes up, put makes money if the stock goes down. That's how we make profits. But when we say it makes money if the stock goes up, meaning you are buying a call option. And when we say that put option makes money when the stock goes down, you are actually buying a put option. So since we are focusing on selling, there are two areas that we can look at, calls and the puts. So I'm going to focus first on selling call option. Let's look at that. What happens when you are selling a call option? Options have a characteristics of time decay, meaning it's a decaying asset. Meaning if you sold for, let's say, $5, and as the time passes, all the time value will go to 0. So it's a decaying asset, meaning it's cash flow positive when you sell share. So cash flow positive meaning you sold once, and if the stock just keep going down, you collect your cash flow and you'll be happy. All fantastic. The world looks that you just found the holy grail of making money and the life is so beautiful. But is it really true? Is there no risk in that? Let's talk about it. Let's look at the call scenario from the very first perspective. A call option makes money when the stock goes up. Similarly, a call option will actually lose money when you sold a call option. It will lose money. This is selling call, this is buying call. So similarly, a selling call will lose money if the stock goes up. So where is the risk? The risk is once you sell the stock, once you sell the call option, if the stocks keep going up and up and up. So now what I'm going to do is I'm going to show you some examples. Let's say if you were to sell a call option, what happens to your position when the stock either goes up or goes down. So while I do this, let me just open my Thinkorswim and show it to you in real time what happens when we do this. Okay, now I'm ready to show you my chart, a Thinkorswim chart, and let's see what happens when we are selling some option prices, when we are selling some options. So on my screen, I have a very famous stock called GME. How many of you have heard of GameStop? Have you heard of GameStop? Anyone? Let's see in the comment section. GameStop. So I'm going to show you what happens to call option prices when you either buy or when you sell, and how much money and etc. you can generate. So let's go ahead and let's look at GME. GameStop. Current price for GameStop is $170, approximately $170.49. And let's say you think that GameStop is overvalued and it is going to crash. So with that perspective in mind, with that bearish view in mind, you decide to sell a call option on GameStop. Let's say you choose something called, say, 25th June. 25th June, and you think the price cannot go above $200, so you go ahead and you choose $200 call option and you sell that. And when you sell this $200, you collect 15.10 credit. The mid price will be approximately $16. So let's say $15 is what you collect. Now $15 you got to multiply by 100, so you collect $1,500. And the stock can go up to $200 and you will still not lose a penny. So what's the risk? Isn't this a free money? Is it free money? Are you carrying any risk in that? Let's look at that. What we are looking at right now is in Thinkorswim risk profile. And if I show this to you, this is the current price. That's where it is at $171. And as long as it just keeps going up and up and up, but it stays below $215, you get to keep that free money. Wow, that looks awesome. In fact, if you understand option Greeks, you will notice that you will collect about $35 of positive cash flow from now, and it will keep on increasing towards the expiration. And this is what you have been told in multiple YouTube videos or internet and everywhere, that you get the free cash flow, you sell the options and then you chill and relax and the money just keeps coming to your pocket. But it's not. Now, let's look at what can go first positive and what can go negative. First, let's talk about the positive. You sold at $171. It can go all the way up to $215 and you will still not lose a penny. If it is below $200, you get to keep all of that money. That belongs to you. You come back 1 month later and you sell another option and keep collecting that credit. And you generate a positive stream of cash. But what if it starts to go up? Let's look at that. What if it starts to go up? Currently it's 170, but what if it goes to 270? What if it goes to 300? What if it goes to 400? What if it goes to 400 and say $50? And at that point, your losses will be approximately $25,000. You realize that? You see that now? This is how your risk reward will look like. If this option just keep going up and up and up, and it can really create a big hole in your account. Now, can that really happen? Let me show you what happened to GME. So this is the stock of GME. You will look at my chart. These are price charts. So those who do not know, it is showing 4 prices on one single bar. These are daily chart, meaning this one single candle is showing you 1 day's price chart, open, open, close, high and low. 4 prices are being shown there. And let's say you are here somewhere around in Jan. Let's say this is the area you are in the month of Jan. And you see, hey, this stock actually never goes up. So maybe we can create, like, let's say 3-year weekly chart. This is 3-year weekly chart. It used to be just $2, $3. Let's just look at this whole zone. You see, it's been 3 years. It actually doesn't go anywhere. So from $2, it keeps going up, creeping up, and it's around, say, $20. And you think $20 is just too much. It has gone 10 times. So it's okay, I can sell a call option. And maybe you decide to sell, let's say, $50 call option. $50. The stock price is $20, but you decide to sell $50 call option and you collected some premium for it. Guess what happened afterwards? Just look at this. From 20, then 50, and then from 50, it just keep rising, and it went all the way $483. Can you see how much that loss will be? Let's just look at the calculation. Let's just understand. So I'm going to go back and show you using my whiteboard on how much losses this position will incur. Reading this, and $20 was the premium, was the stock price, and you sold, say, $50 call option, and $50 call option, and you collected, let's just say, being extremely generous, that we collected $5 as a credit. And because one option controls 100 share, so $5 times 100, $500 is what you will make. That looks so fantastic because you are selling that option and it looks like that it is a low probability event. But it keeps going up and up and up and up and up. And as it's going against you, let's say the price reaches $450 that I just showed you in case of GameStop. And you sold 50 strike, meaning your loss is $400. How did I get 400? 450 minus 50 gives you $400. That is the loss. But you have 100 shares, meaning you also need to multiply by 100, and your loss is $40,000 in that position. $40,000. And for $40,000, remember you were just collecting 500 and your risk becomes $40,000. First of all, your account will be completely depleted. You will have a massive loss, and I don't think you will ever sell options all over again in your life. This is the biggest risk when you are selling a naked call option. So there are multiple ways. How can you mitigate? What are the things you can do to manage this risk? But you understand from an option selling point of view now what kind of risk you will be carrying when you are selling a call option. And the story is not very different when you are selling put options as well. So I will briefly cover put selling today. We'll talk more about put selling as a dedicated topic because there are many of you who sell put options. Then what are the risks in selling put option? I will cover that in another lesson. But right now, let's just focus on if we want to sell call option, if the premium we are collecting, what are the things we could do to mitigate the risk? Who would like to know how to mitigate the risk? Are you interested to know how to mitigate the risk? If you are selling a call option, if you were doing this on, say, GameStop, let me share that with you. What are the things you can do to mitigate the risk? You sold 50 call option, and as long as the stock keeps going up, that will be a risk. By the way, before I share, can we have some fun? Hit like or hit love if you're enjoying these sessions, in these conversations, okay? Because that's the only way for me to know that we are having a dialogue, that we are having a conversation, that you're enjoying this session. You're seeing now from a very, very different perspective. So hit some likes, hit some love, whatever you like, send some emotions. That's the way that I can see or I can connect with you on how you are feeling. Great, so now I'm going to show you the secret on if this is what is happening, so how do you manage the risk? So we sold 50 call, and above 50, our risk is unlimited. But do you remember call option makes money if the stock goes up? Yeah, so if you sold this and you actually decide to buy, let's say, a 60 call option. So whatever money you are making, just take some money and give it to buy a call option. So if you buy this call option, let's say you pay for it maybe $2. So you paid $200 for this, you collected 500, so your net gain is 300. But if it, so your risk will be limited at 60. Now, if it goes to 70, goes to 80, even goes to 1,000, you cannot lose more than the difference, which is $10 in this case, minus the credit that you received $300. So $700 is the maximum risk, whatever happens. Whatever happens. So even if the stock goes to $1,000, $5,000, $10,000, you are not going to have any additional risk. So you will make, let's say, $300 on a risk of $1,000. 1,000 why? Because this is 50 and then 60. That difference is $10. So many of you, you have been watching the videos, you have been learning at multiple sources where you have probably been taught that option selling is great. But if you don't do the option selling in an intelligent way, it can actually cause you a lot of harm in your portfolio. So let me show you some examples, some of the stocks which have gone through some phenomenal rallies like this in a chart right now. So give me a few minutes. Let me go back to my Thinkorswim and show you some of the stocks that have gone through some exponential phase. Now, if you are a Profit Path graduate or Option Success Formula graduate, you all know how we trade call options if we are selling, or how do we sell options in a much smarter way so that our risk is defined while our gains are consistent as well. Okay, so I'm going to take a minute and show you on my Thinkorswim screen how does it look like. So once again, if you have any questions, you keep writing onto the comment section. I will come back to it and answer the questions that you may have. So I'm opening my Thinkorswim now and I will show you how it looks like. So you have already seen Thinkorswim, you have already seen GameStop, and GameStop has gone through some amazing rally. Now these rally took place because of a phenomenon called short squeeze. And do you want to know about short squeeze? You want to learn what is short squeeze? Let's see if you, let me look at the comments if you want to learn someday about short squeeze, and I'll be more than happy to either organize a session, a specific session just on short squeeze in one of these live sessions. Okay, great. So what is short squeeze? We'll talk about in another session. So this is GameStop. Now let's see some other one. There was a company called AMC, and look at that, what happened to AMC. From $1.91, the squeeze took place and the stock rallied almost 20 times in less than, 10 times in less than 2 weeks, less than 2-3 weeks. So if you happen to be, if you were caught in this short squeeze, then option selling game is over. Okay, let's see some other one. It was I think BlackBerry. I think it's the stock symbol is BB, BlackBerry. Yeah, BlackBerry. Look at that. And BlackBerry was around $4 or $5, and then in just the next few days it went up. Few weeks it went up to $28. Let's look at Tesla. Is a great example as well. So Tesla was here, and if somebody was selling Tesla shorts, you can see Tesla actually went from $80 all the way to $900, and the person wouldn't even have a chance to do anything in their portfolio because they will be caught with that situation. Now similarly, let's say let's look at some other stocks. I think the other one was on China stock called Futu. Look at that, from $30 it went to $200 in just a matter of few weeks, from $20 to $200. So if you are selling call options uncovered, naked, you are carrying huge amount of risk to your portfolio. You need to learn to do it better, and there are smarter ways to earn similar type of income without exposing your portfolio to such a huge risk. Let's see some other stocks that have gone through. Any other stocks that you have personally experienced which has gone through some explosive moves like this? Let's just see if you have gone through. Now the question that comes from Chong is Can they close the sell call options anytime to minimize the loss? This is an excellent point. Can you close it? What do you think? Can you close it before? Can you close? Actually, the biggest risk is gapping up. So you slept with a calm, nice sleep, thinking that your GameStop is just $20. And suddenly the next day you wake up and the GameStop is already under the short squeeze and the stock is already like $50 or $100. Then that is the only time you can sell or close your position, when the market opens. But till that time, you are carrying that gapping risk. So yes, you can close it, you can book your losses, but if it gaps up hugely, you don't have a chance to close it. Another one was Nokia. Okay, let's look at Nokia. Yeah, look at Nokia. It was about 4, and in that week it went to $10. Can you see that? It's like, you're collecting pennies in front of a steamroll. Like really, the risk is just not worth it. It's just not worth it. There are much better way, much smarter way. Another one somebody mentioned is Palantir. Palantir didn't really experience that kind of explosive growth. Maybe you can say, yeah, from $9 to $30 in around 4 weeks. Yeah, so Palantir also went through similar move. Any other stock that anyone experienced on this? Any other stock? By the way, as we are going through this, I talked about that you should learn about options as well. We have a free upcoming 3-day class. Yes, you heard it right. 3 days free for those who will be joining. My team will be posting a link. If you want to join in, you can join in. It's no cost, complimentary, 3 days classes. You will learn about options. You will also learn about the financial instruments and the personal finance in general. So they are going to post a link. Feel free to join. If you are someone who has already attended Profit Path or OSF, you will receive a very, very special email from me. So I'm going to send that to you separately. So don't need for you, there is no need to join in, but you can share that link for free with everyone. And maybe I can show you how it looks like. Would you like to know about the 3-day workshop that we are conducting? Once again, it's complimentary, it's free. Main page, OptionPundit.com. And there you click on book your seat now. You go to OptionPundit.com and you click book your seat now. And you will see that we are conducting the 3-day option masterclass. 3-day option masterclass, it's happening. And it gives you all the details as well. And in fact, it will have a dedicated portal where you can see exactly all the PDFs, worksheets, and the downloads that we are going to keep it for you at one single place. At one single place. And this is, you will also have the trading ideas that I share. You will have your questions answered live, interactive. It will be me taking you through those three-day sessions, and there is no other coach. So just enjoy, make yourself available, and enhance your learning to a completely new scale, a completely new level. And once again, it is totally free, totally free. But we do have a limit from a Zoom perspective. We can't have more than what is being given by Zoom. So you want to make sure that you book your seat now. Whether you join or not join in, at least you book your seat. You can free up your calendar and schedule later on if you would like to join in. Feel free to share the class with those people who you think might benefit. It's the chance to learn about markets and learn it for free. For free. This is a 3-day workshop that will be taking you through. So you can learn more about options during those classes as well, and we'll be more than happy to take you through that journey. Now I will go back to option selling. My team will put the link there, and we will also appreciate if you share this with your groups or your trading buddies or other people who you think might benefit from it. Fantastic. Now this was PLTR, and we can open up to the questions now. Today, in this brief, short, crisp session, I covered option selling from a call selling perspective, and I showed you the risk which are present when you are selling naked call options. I also showed you one nifty technique, on how you can manage that risk very well and still profit from it. There is so much more that goes into it. So when I'm organizing the next session about put selling, I will reveal to you what are the risks when you are selling put option. And there are two risks that you actually do not know. In fact, there is one major risk that most of the people do not know when they are selling put options. And it's a huge risk if you sell put options. So you may want to stay tuned to that FB Live session as well. So this session was focused on option selling from call selling perspective. And my conclusion is it's risky. It's utterly risky. You need to learn how to manage your risk very well when you are selling call option. Now let's go ahead and let's take some questions from you. Closing a losing position, I see there's one. So we talked about, Serene, Stephen Lau. Closing a losing trade is difficult for 50% for human population. That's absolutely correct. It's so difficult to close a losing trade. I mean, I've been there. Has anybody been there? Like I personally felt if a trade is already losing, especially in the beginning of my trading career, if a trade is losing, it's so hard to close. It's so hard to take losses. Anybody else experience that too? Let's go ahead and see other questions. Is it wise to sell into the strength? So it's a good question, Michael. Is it wise to sell into strength? Now it depends on how you sell. First of all, strength means that the stock is stronger, right? That the trend or there is a powerful force behind that particular stock which is driving it higher. So you can do it, but you got to do it in a smart way to make sure that your position is not being run over by the continued strength in that stock. I showed you an example of GameStop, and the stock went from $20 to all the way like $450. At what point would you call out its strength? When 20 goes to 50, or 50 goes to 100, or it goes to 200? What point? So, which is why when you are selling naked call options, you have to do it in a smart way that your upside risk is limited. Okay? Let's take another question, which is, while it is the uptrend, how do you stop loss to protect us in Think or Swim? You can place price alerts, and those price alerts, especially on the stock, will let you know whether or not your stock has reached to that price. If it has already reached to the price, you will get an alert by your broker. But the biggest risk you will be carrying is the risk of gapping up. That is something you will not be able to receive an alert. You will only receive alert once it starts trading. Next question is, how do we choose the strikes price to hedge the selling call? You have to look at your risk reward ratios. You need to look at your charts or analysis, like what is the right risk to reward ratio, or what is the most likelihood that the stock will go up to. And then it's like hedging at that place, making sure that you build your territory, like your fort, and beyond that you're totally safe. So you can take a risk in the beginning, but then afterwards you need to start protecting it very, very aggressively. Next question is, when selling call spread, if price of underlying falls between the two strikes, do we need to manually exercise both options? Melvin, your broker will exercise it for you, and you will be short shares if the stock expires between those two option legs. Let's go ahead and let me see another question, which is from, we can also manage our risk by selling covered calls as comfort. Yeah, that is absolutely correct, Joshua. You can do that too. Next question is from Lana. So would you suggest our trade should be covered call or put? How you did it for GameStop, a sell call and buy a call. Can you show another example? How would you manage the trade? Leonard, it actually is the same. So if I look at my GameStop here, and by the way, if I answer your question, can I just have a like? Can I just have some comments, some love? Okay, let's look at GameStop. So here, I'm just going to show you some price levels. Let's say I shorted this $50. Okay, this is the price I shorted, and I built a hedge around $100, let's say. So this is the only zone where I will experience my maximum loss. That's it. Beyond this, even if it goes to 150, 200, 250, 300, 400, 1000, no further losses. So this is one of the smartest way to protect your losses, by creating that hedge. You can do that you can do the same for any other stock, whether it is Shopify, whether it is Tesla, or any other thing. You could exactly do this simple approach to safeguard your capital. I'm interested to know the risk for selling puts, since today is options expiration Friday. Yeah, Joshua, we are running out of time, because these short live sessions have been created to at most cover one topic, and we can stay to the topic, give you precise answers. But in selling puts, there are also huge risks that you need to be aware. I will cover that in one of the future sessions. Next question is from Andrew, which is, can we do a simultaneous sell call and sell put to prevent GameStop, etc.? Andrew, that is, it can be a strategy, but this is not a great strategy that you sell put to cover on the sell call side, because then you're exposing yourself on both the sides. You're only covered to the premium, you're only covered to the extent the premium you're receiving by selling both the option, but you are magnifying your risk. That, in my opinion, is not really a smart way to protect yourself on that position. Okay? So once again, if you hear your name, if you hear your answers, just hit some like, hit some love, and we'll continue. By the way, are you enjoying these lives? I think this was our 4th session or 5th session in continuous running, and you guys have been sending, guys and girls, you have been sending us the emails and the appreciation note, and I just want to tell you that from the bottom of my heart, I really love it, and I feel excited. I feel great that these sessions are helping you, especially on Friday lunchtime, and we can show you. So spread the message, let other people know the options journey that we are taking you through. Let them know the skills we are sharing, the knowledge we are sharing, and it's all free. They don't need to pay anything, but still get to know the options world as well as personal finance world. We'll include more and more topics. If you have topics that you want us to talk about, mention those topics in the comment section as well, and we can also create a section around that. Markets are great. Today is an option expiration day. Make sure you are taking care of your positions very well. There might be wild moves in the markets today, and especially on Monday, coming Monday as well. So make sure you are taking care of your portfolios, your positions, and your capital. Remember this, capital allocation is the key, Anything times 0 is 0. So you have to be guarding your capital. You have to manage the risk very well. This is your hard-earned money that you invest in the market, and you do not want markets to just take it away like that because you did not do your homework, because you did not plan your trades very well. So with all that, I wish you all the very best. I look forward to seeing you in the next FB Live. And if you enjoyed it, if you had fun, if you learned something new, if you had aha moment, capture that learning, put into the comment section. I will go back, read through it, and I will also answer any questions that you might have on the chat, on the comment section. So with all that, wishing you all the best. See you again in the moment for the moment. This is Manoj. Stay safe, stay healthy.